Thank you all for joining in. We'll just wait for a couple of more minutes for more participants to join in. We'll start in about 5 to 7 minutes. All right. Let me just start projecting and then see, it's a long presentation and I mean, it's a new topic for everybody. So let me just project it. Hold on one second. Hold on, yeah, I'm just having some issue with this, with US technology. Can somebody give me a thumbs up if it's all seen? All right. Yeah, I think everything is fine on your end. Nothing is, I'm not able to see it itself. Hold on. Hold on, I'm just trying something. All right. Now is it coming? Yeah, perfect. I think now it's seen for me as well. Okay. Yeah, give me a thumbs up. All right, perfect. Okay, so I'll start off with the disclaimer first, right? This is unlike our presentations because uh, somebody said no. Yeah, I think it's coming. I'm able to see it. You are also able to see it. Just give me one more. Okay, done. Okay. So I'm starting off with the disclaimer first. Look, all of this is information only. It's only educational. There is no recommendation, no nothing. Treat it as education. I'm very, very strict here. Treat it only as education. Some of it might be dated. Some of the data might be a little dated, but treat it only as education. All right. Another disclaimer, we own it and we are trimming down. So NIO, so the investors in NIO, for the investors in NIO, we do own it and we are trimming down. All right, but we do own it. Right. So two disclaimers given to you right up in the beginning. Use it as educational purpose only. And we do have ownership in this and we are trimming down. All right. Okay, so why Chinese technology company, right? We are looking at it more from a Chinese technology oriented, like where the real opportunity in China is, right? You look at Chinese technology companies, Xiaomi, the second largest manufacturer in the world, Tencent, the most valuable Chinese company in the world. You have JD Well, then you have Alibaba, then you have Pinduoduo, I think that's what it's called. So you have many market leaders coming in, industry leaders or world leaders that are listed on the China side, right? So these are particularly Chinese companies, right? And I know most of you that have come here are Indian investors, and some of you might already be residing here, but this is strictly for non-resident Indians and for investors on NEO, right? So no overlap of anything, strictly for NEO, right? Okay, now if you look at what the government has been doing, right? They've been giving since 2014, right? The focus has been more towards technology, right? You look at the first fund in 2014, it was heavily focused on IC manufacturing, semiconductor design, packaging, testing, basically moving away from state support to welcome more market-driven approaches. Very important for you to know that they said that they want to move away from state-driven, right? Point number one, right? So the nature of significant domestic players such as the semiconductor manufacturing companies, right? So this will nurture, right? So yeah, SMIC, you would have heard all these businesses already, on Twitter, social media, everywhere, right? So you look at this that came out in 2024 of last year, right? Major focus on equipment for chip manufacturing to reduce dependence on Western companies such as ASML to try to develop an indigenous industry, right? All of this is happening through, all of this is on the ground. So, and all of this is state backed, right? It's not private driven, but most of it is state backed. So this poses a very big risk in terms of technology itself to the entire world. So imagine if the largest equipment manufacturer for semiconductors gets disrupted, where that monopoly goes away, and you're able to produce. Look at this. In 2024, the idea is that we would like to produce our own. We would like to produce something that is very cheap, and we have unlimited funding that is coming in from the government. What happens then? Right. A very good example of that is your DeepSeek that had disrupted your current models. They're pretty fast, pretty efficient, and that led to a big sell-off in the in the US technology, right? Nasdaq, because they're flowing in more and more and more money, and it's more expensive for you to sort of produce that, right? And put in that level of capital into it. But here you have something where uh, you can develop something much more better at a cheaper cost, right? So that's the level of disruption that we're talking on when it comes to anything related to China, right? So you look at what they have been doing, the Bank of China's AI industry development plan. All of these are just, it's information, right? Why, what has happened towards Chinese technology, and what is the negatives that are there, and can there be an opportunity again, right? So it is 1 trillion yuan, which is $137 billion over the next 5 years, allocated to equity and debt. The core objective is to strengthen the national technology reliance, self-reliance, right? Enhance AI infrastructure, accelerate AI innovation, and application development, right? So the key areas are AI-driven robotics, biomanufacturing, advanced materials, all of that. So you get the sense from everywhere, right? Since 2014, that the government is going more and more towards technology, away from that traditional uh, real estate sort of investment, right? So they're going more and more and more towards technology, and we have certain slides to also show the impact that the 2000 to 2010 2011 sort of era has on its on today's Chinese world, right? Okay, now this is what I was talking to you about DeepSeek. So they've come out with one more called, I think it's called Doubao, uh, where they are much more faster than DeepSeek. They're much more efficient than DeepSeek. And you have a range comparing it to other AI tools, other AI softwares, where Chinese are just coming up and being market leaders even in this. Right. So there's a lot of disruption happening right now, and a lot of bullishness that is coming along with this level of disruption that is taking place. Right. So what are the effects? Like there was some slide that said biomanufacturing and something to do with biotech. Right. So you look at that spillover of efficiency in Chinese tech is that Chinese drug discoveries are now on a rise. So since 2018, you see a lot of drug discoveries, more new molecular entities originated in China than Europe itself for the entire of the last year. So lot of the innovation that is coming in on one side is spilling over everywhere else. And the objective of them being a market leader across industries using technologies is clearly visible, and that is happening. Right. So you look at the Chinese ETFs that there, and we have one ETF here in India, which is technology oriented, right? Which is the Hang Seng Tech ETF, right? So I'll get to that at the end of it. But so you look at the revenue growth is on an average, it grows at a 32% sort of odd. This is the past history that I showed, and in terms of the uh, 5-year growth rate, they're still doing phenomenally well. But you look at US technology oriented companies, so they are outpacing US technology oriented companies as well in terms of your top line, right? And in terms of valuation, they are much, much more cheaper than that. And they are cheap for a particular reason. It's not that there is something else going on and that they are, it's not like a value investing sort of style. No, no. This is more like an actual issue that the government has put on. There's a lot of government intervention that is coming in, and hence it remains cheap. It looks to be cheap, right? That's what I would put it. It looks to be cheap, right? Now, looking back, so you look at the many reasons that has taken place in the Chinese internet index, right? And the major one being there was a regulation change in terms of foreign assets, right? So that was a very, very big move that came up, and that posed an extremely big risk, right? But what is already being priced in, your macro picture is already being priced into this, your delisting concerns are already being priced in. But I will talk to you more about the delisting concerns, because ultimately you need to know whether you are owning the shares or not, right? Whether you will be able to own it or not own it, right? The whole idea of equity investing is to own, to be a part owner in the business, right? So then you have a global slowdown, which is again there. So China aside, US aside, the Chinese economy works in a particular manner. They have their own they have completely dealing themselves in terms of currency, in terms of interest rates, in terms of everything. So you already see that they've been largest sellers of US Treasury, and they've gone more into gold, and you see the price of gold today. So disruption happens whenever, like Reliance, disruption happens whenever Chinese enter. Right. Now, this is very important. What is a variable interest entity? Variable interest entity is a legal structure in which the controlling interest is determined by something other than majority voting rights. Right? Look at what I've highlighted. A VIA is often established to protect a business from creditors or legal action. Right? Now, while VIA can be valid business structure, the analyst says that these Chinese VIA companies that are listed in both Hong Kong, which is what we buy, your Mira Hang Seng Tech ETF and all the other listed ETF, we buy it from Hong Kong. So both in Hong Kong and the United States do not have common equity in existence on any public market. So what are you buying? You're just buying a paper, right? You're buying a paper that moves up and down. There's no legal ownership that you have. So this is what the policy is all about for China, that they don't want to have any foreign ownership at all. Right. So thus buying many of these popular Chinese stocks is akin to buying a pre-IPO private equity fund. No one has the voting rights with all these companies, since most of it are not allowed to list in the first place. Right. So this is why you need to go to a managed professional when it comes to understanding these level of risk, because when you're just sitting and seeing the performance go up behind the screen, it looks like it's all rosy good, but no, it's not at all rosy good. There's a particular reason of why it takes time for things to change. You're seeing a lot of sentiment change coming in from the Chinese government over the last 1 month in terms of how they are looking at being pro business now again, right? But the whole point is that what are you buying into? You're not buying into the actual shares. You're just buying into a particular paper, right? So you're not going to get any shares in return. Nothing you're going to get, even if whether you invest in the US or whether you invest in the Hong Kong, right? So now, what does the SEC say about this? They say that VIs receive greater scrutiny. All right, then VI is a complex. So since the 2000s, where the Chinese companies have used VIs, they're complex structures that grant shareholders contractual claims to control via an offshore shell company without transferring the actual ownership in the company. Right. So there are currently 166 companies that are listed on 3 major exchanges. These companies account for a total of that use VI. But what has happened is you see the level of delisting that has taken place. So delisting is a very, very big risk. From 1.85 trillion, it has gone to somewhere between 700, $800 billion. Right. So this is real. Right. So you have a big risk in terms of delisting. So what did the major ETF globally? What did they do? Right. So they also went and converted their US holdings to Hong Kong shares due to the delisting risk that was currently present. Right, so where it was majorly US, they converted all of that to Hong Kong, which is nearby, right? But still, they do not get shares. It's still considered as offshore. It's not considered as onshore. Anything that is onshore, right, is what you have equity shares for. Onshore, which is only in China, right? So now, who is buying these Chinese stocks? Right? Why do you see this big jump up in terms of these shares? So last year, when the rate cut happened, right, your Chinese state-backed funds bought $57 billion worth of Chinese stocks. So the report says that more than 75% of the inflows went into the benchmark, which is like how we have the Nifty 500, there it's the 300 index, and 13% flowed to the 500 index. Right. So state funds have been key to stabilizing the latest stock. This was last year. Right. So now also you're seeing a lot of money that is continuously keep on going in, where a majority of the participants are not foreign. The majority of the participants are Chinese. Right. So you look at global flows that have been going this year, global flows have been coming out of China, whereas your southbound connect, right, most of it has been going inside, right? So all sides last year also, they were continuing to buy, and they said that they will continue to buy, right? So you see the ETF volume continuously going up. So it's not their retail investors or anybody. It's not major institutions that are going in and purchasing. Whatever you're seeing and whatever you're reading outside is purely speculative. Purely speculative, because the reality is that it's more of the state backed funds that are going in. Even now you see that yes, this validates that even this year most of it has gone there. Right now, we've seen a positive correlation to the Chinese currency movement, and this is one more validation and proof to say that yes, majorly it is your government only that is participating. So where we had a negative correlation since 2016, from 17 onwards, ever since Trump has come in, you're seeing a more positive correlation of all these Chinese stocks to their own currency. Right, so it goes up, and then as the currency strengthens and weakens, your listed, that is your equity market, also goes along with it. Like this technology index also is going up along with it. There's all proof saying that no, whatever you read outside is majorly speculative in terms of this investor buying that and that investor buying this, but most of it has been the state government alone. Right. Now we look at the Chinese macro. This is another big risk. Why am I talking to you more about the big risk? Because I think most of you know the positive. We covered most of the positives that are there. Right. So you look at it from in history, right? There has been an excess of capacity addition that has come in on the Chinese side, right? This data actually goes and proves that level of misallocation that happens, right? The cumulative misallocation is somewhere between 300% of GDP for your gross fixed capital formation. Usually it's 100, 150, something like that, but they did double of that, right? So your actual, your required look at the red line. The required fixed capital formation is the red line. This is what economists say, right? This has nothing to do with, this is just purely data. This is what, your economics say, right? But your blue was actually what they went and spent on, and that has huge ramifications. Basically, you front load a lot of the lot of the growth, and then when the growth does not come, you have to keep on writing down all everything that you did. Right, write down those assets. Right, so then that poses a big risk for you in terms of future growth, because you have long periods of slowdown, you have long periods of deflation that coming in, which is what is currently happening on the Chinese front, right? So you look at real GDP post depreciation, right? Once you know you're writing down all of this is slightly dated, uh, has been growing very slow and has been growing negatively. Right, so your negative growth has been fast, your positive growth has been extremely low, nothing is there, right? So that's why you see this deep bit of slowdown that's coming in. That's why most of the money has been going more towards technology, where efficiencies come in, where you have where that level of deflationary environment is controlled, and then again you start seeing a spur of consumption coming in because it's technology. So in China, everything works like this, right? Likewise in the US. Right, you see a lot of innovation that is coming in there. For example, TikTok Shop is just crazy. People there are seeing a reel within 30 seconds, are able to decide what they want to do, and then buy $1,000 or $500 sort of a product. So right then and there. That's how consumption works there. Right. And there's a lot for us to continuously keep learning in terms of how these models work for China. Right. Now, so this is that particular risk in terms of Chinese banks. So when you look at it from an investor standpoint, that yes, you are taking, that bit of risk when it comes to investing on this China side, though it is being, let me go back to that slide, though it being very cheap compared to its US competitor, right? You have a macro risk that's there, and the micro risk that's there majorly is that the Chinese government can do anything to these companies. Over the last 3 months, they have been talking more pro-government stuff, and hence you see a huge performance that is coming. And I'll get to the performance slide also. Uh, right. So ever since DeepSeek was announced, right, you saw anything that and everything that had to do with AI and technology just skyrocketed. Right. So how many of you have actually used DeepSeek? Right? How many of you have used DeepSeek? You can put it on the chat box. Haven't used it yet. Okay. How many of you has used any AI model, yeah, apart from ChatGPT? Okay, you have. It's quite good. Yes, I've used DeepSeek API. All right. So I have not used DeepSeek, but Perplexity is a very good model that I'm using as well. But you look at what has happened, that level of disruption that takes place when everybody is going and everybody is talking more and more towards ChatGPT, or small news that can come in also, or small disruption also that is there, can have huge ramifications on the entire technology world, technology listed companies in the world. Look at this. So from that DeepSeek announcement, after that, the price has just skyrocketed. Now, one important news, I could not put that here, but in India, there are no more of money going to global businesses, right? Global funds or global ETFs, because it's shut, right? The RBI has shut. So no new money can go into your fund of funds, your global fund of funds, and your NASDAQ ETFs, and your all of it, right? So you cannot create more units. So what is there is actually currently being traded. Only that is there. And what is happening here is that your Chinese ETFs in India are trading at a significant premium, right? And the premium is somewhere between 16 to 18%. So there are days where the ETF did go upper circuit, but it was locked. You could not do anything because it met its cap of it being a 20% premium to its NAV. That is very important for you to know, because I'll just share that data as well. from the 1st of January, right? Your Chinese tech index till 18th, this is of last week. We were able to take that data of last week because we were working on that particular data to know what we can actually go ahead and show you. That the index has done, their index has done 26.21%, the pure index movement. But in India, our Chinese ETF went up by 35%, right? So there's a gap. That gap is coming because of the premium that we are paying to purchase the particular ETF. And we are paying a very, very high premium. So the ones that have actually held it like us, for us, we are able to benefit more of it because there is a high premium. So when you want to sell at the exchange, we can just straight away get the premium. But for you, when you look at it as a particular idea, you will be buying it at a premium, which is not going to be feasible for you. Right. So that's why I said that this entire thing is education only. It's a pure disclaimer that you have to be very, very cognizant. Because we are also, because when we started to buy this entire thing, the premium was very low. It was nil to negligible. Right. But today, since no new units can be created, it is trading at a very, very high premium. Be it your Nippon, be it your Mire, anything that's there, because no new units can be created. Your Chinese ETFs are trading at a very, very high premium to its NAV, particularly in India, and hence you are seeing that very high return coming in, right? Assuming that China opens up the limit and says that you can have, so that it gets repriced to what it normally should be. So the premium goes away, hence you lose, right? Hence you lose straight, right? So we are very cognizant of it, and hence that's why, since the premium has gone beyond and we are able to see that visibly, that our decision has been that we should not take that much of risk for our investors, right? And hence that reason has come up. All right. So now I'll get to what NIO is doing. All right. Your NIO is no cap on any particular asset class. Since we did not have a cap, we were able to take a view on this idea back in 2023 when it was here. Yeah, when it was extremely here, when the negativity was continuously there, we were able to take a good call here, knowing all these risks, right? So all these risks are not today's risk. We knew the risks when we were buying it. Hence, that level of position sizing was set for us, given the fact that it was cheap, right? So how do we maximize our yield? So we go at it more from a top-down and a bottom-up opportunity. This was a more top-down opportunity where it required a passive strategy rather than an active strategy. Hence, we were able to take a global ETF, right? But for a bottom-up strategy, for a bottom-up opportunity, we do go ahead and use active strategy. Even for a top-down, we use active strategies where we can straight away go and buy the direct equity, or if there's a call for debt, if there's a call for metal, we can straight away go and do that part of ETFs, right? Likewise for bottom-up, it remains the same. Now, how have we done it for the India side? India side, majorly, since we do not have a position here, we are at liberty to speak to it. About it. Public sector banks, we used a more top-down approach where it was passive, and after that it was more. So we chose a more sectoral ETF. So it takes a long time for us to go ahead and build a big position. Likewise, we build this position from 2023 all the way up until now, and now only you're seeing some bit of risk off that is being taken place. Other things are being evaluated in terms of what the fundamentals are. Fundamentals are looking extremely strong, but today's risks are very, very high when we have to pay that huge premium on the exchange, in the market, right? So we go on a buying spree, and then when we are done, we go up and holding it, and then when the time comes, you will see a small exit taking place from our side, right? So so the entire objective of NIO is that we want to build versatile portfolios that prosper in all markets, right? So in cases where there's inflation, interest rates go up, then your fixed income goes and sort of outperforms, and you have high growth. This cycle has been completely different, right? And this cycle, you see gold do extremely well despite US rate, the US currency going up. So there are a lot of moving parts that are going there, which means that the inherent strength is very high for that particular metal, right? like that, right? So when you have a low growth and you have a dynamic strategy, and hence multi-asset outperform. So we are going with that uh, philosophy that yes, we don't want any particular cap on any asset category or asset class, and we can go 0 to 100 in any asset class, be it equity, be it debt, be it global, be it cash, be it precious metals, right? We've created that model in such a way, right? If you see how this has done, this is since December. Today's, I think, second. So I think couple of days later we will get the March data. But anyway, for what it's worth, we are falling lesser than the market. We are performing better than your FlexiCap funds. This is over the last 3 years, but this is a model that we have uh, used for the advisory business as well. It's the same model. And for non-resident Indians, we will not do mutual funds, but we will be able to do for non-resident Indians, we will be able to do ETFs, but not mutual funds. All right. Drawdowns have been very good. This is 31st. We have not seen that level of drawdown itself up until now, but maybe a couple of days later, when the data does come out, we will be able to share more data with you. So if you do want to know, just send us a hi, and we can send you that data, no issues whatsoever. This again, data is a little dated, but I can try to get that data. Hold on. Okay. So right now, NIO has a 75% towards equity, 4% towards global, yes, 16% towards precious metals, and the rest in cash. So it's exactly right. That's the same data that we are having. Right. And as of January, your 1 month is 0.6, your 3 months is -4, your 6 months has been 1.6, your 1 year has 23, and your 2 years is 27, right? So since inception, it has grown somewhere, but it's the same number only, so somewhere between 25% or so, right? So this has been since inception, and the whole idea for NIO is that we operate somewhere between moderate to conservative. So when we take these broad-based high conviction calls, we do not try to take these high conviction calls unless and until all the negatives, all the risks are completely priced in. And if it makes sense for us to invest in. So we have a checklist, right? So this checklist shows that yes, a lot of negatives have been priced in, number one. A lot of risks are already priced in, number two. Third, we cannot do without these businesses. They are quite large. China as a country is extremely large, and they are market leaders, right? So our philosophy of buying market leaders continues to be there, and hence it did come to us in terms of it being a good contender for addition, and hence it came in during at that point of time, knowing all these risks that were there. So we were always on the lookout for risks to sort of develop and evolve to see if something more negative does come up, we have to reevaluate. But from there on, most of it has been extremely positive. So we're very lucky in terms of being able to catch it at the right time. And this level of up move in India, we did not project that it would trade at this level of premium, and hence that is a cautious point for us, right? So hence, so the model that we are operating is somewhere between your moderate to conservative. So it suits all risk profiles, right? Because we are very conservative itself when it comes to allocating money, right? So the return expectation is that average inflation plus 5 to 7% is what we look to achieve. So don't look at our past returns. It does not matter what we do from here on. And the expectation that we're setting from here on is average inflation plus 5 to 7% return. Right. So the minimum investment is 50 lakhs. It's a fixed fee product. There is no profit sharing in this. Like I said, we can go from 0 to 100 in any particular asset category. It's a fixed fee model of 1.5%. So you start off with 50, and let's say 1 year down the line, it's about 57 or 58, whatever the return is. We charge you on the 58. All the dividends are come to you, which itself would be somewhere between 1.3 to 1.35%. And there is no profit sharing model for this particular product. So there are 4 products that we do have, which is Solitaire, True Blue, Vriddhi, and Sphere apart from NIO. Sphere is the uh, Indian resident product, which is the multi-asset product. NIO is the non-resident Indian multi-asset product, right? We split it because we cannot buy the mutual funds here. There's a lot of complications when it comes to investing for non-resident Indians in the US and Canada side. Hence, we've kept it separate. So the structure for your paperwork, everything is different here versus that of the Indian resident one, right? Your Vriddhi is the small cap one. Your True Blue is the large cap PMS, and your Solitaire, which is our flagship product, is uh, FlexiCap, right? So we have Balaji sir, Rohit, Rajat, Niranjan sir, who are part of the core fund management team. And then you have the research and strategy. Strategy is where we are part of, where we take care of the NEO and the Sphere product, right? All right. Now I'll open the floor for Q&A. No, like I said, we own it still. This means have you exited the Chinese ETF? Like I said, we have owned it still, but we've been very cognizant of the risks that are there and hence taken that risk off for our investors. Like I said, that was the first slide, right? We own it, uh, and we are cutting off the risk. This is purely for investors on NEO and Sphere. Again, this is no recommendation for you. This is purely educational, but as a disclaimer, we have to tell that to you. This is the entire presentation is purely educational because there's a lot of word that is going on in the market. Whether you should buy this, not buy this, the many things that are coming in. So the investors that we want to work with, we want them to be prepared. We want them to know who they are working with, what they are dealing with. Is there any other way to enter the Chinese market? Invest in the US part. Open an account in the US and trade from there. But from India, you can't do anything. You mentioned that the RBI limit has been, yeah, so they met the limit. Let me share that limit with you. So each AMC can do has a cap of $1 billion each. So that limit has been met for across the board. Yes, $1 billion for each AMC, $7 billion industry wide, and additionally $1 billion for ETF. So everything is met. what's your opinion on gold? See, the call for gold that we have internally is that, see, from a fundamental perspective, the buyers of gold have been majorly central banks and not the ETFs. And we've been owning gold and buying gold since 2018, right? Because we understand that the risks and the geopolitical tensions that were there were very, very large, and global trade was getting disrupted again. So there had to be one particular, we see it as a currency, and you need to see this as a currency, not equity versus gold or versus debt, but as a currency. And if we say that the debt levels are so large, inflation is uncontrollable, and whatever you do with the interest rates, you're not seeing a bit of any sort of good impact that's coming in, then your currency is at risk, which is what your dollar is at currently. Right? So from that logic, that yes, gold definitely is a very big hedge against currency. Right. So the opinion on gold and precious metals is positive. Right? Some AMCs have a Greater China fund, and still they are accepting. No, I don't think. Yeah, industry wide, it is shut. You can't do anything. Uh, then when can the AMC again open for subscription? Only if someone sells. No, only so these are all for the units that are created, not for the ones that are being traded. For the ones that they have created, they have met the cap. After, beyond that, they are not supposed to create. So it's not sell, and only when somebody sells it will open. No, for any new thing, they have to sort of open it. And when it does get opened is when you can create more units. And when you can create more units, again, it's like you're giving them shares. It's like shares, right? When you get ownership of it, right? So units is when you get it, uh, is when you will be able to buy it. Other than that, there's the AMC cannot create anything new. And in fact, that Greater China Fund is an onshore fund, I think so. Access. Yeah. Okay. Answer not clear. Can you explain? Look, the point is that only when the AMC is able to create more units. Suppose if I'm running a fund, whether it is Indian, global, whatever, I have to create more and more units, right? So when I'm creating more units, it's actual money that is being given, right? So I've taken money from you and I'm giving you the particular units, right? So what I've given, what I've collected has already met $1 billion. That's it, right? So I've already distributed that much worth of units at whatever price. So I cannot do more. That's it. That's the cap. I have joined in the middle of the program. Can I get a full video after this? Yeah, it will be there in on YouTube. Okay, how much minimum amount is required to invest through your PMS? No, no. So the minimum amount required is for a PMS in India, it is 50 lakhs, right? investing in China is a separate thing. That is what we are doing via ETFs. But the minimum investment to do is 50 lakhs. The entire 50 lakhs does not go in the China. It's not compulsory that it has to go there. Right. So it's a managed service. Right. But a PMS, the minimum investment is 50 lakhs. Right. So we can invest across the globe, which is US, wherever US, whatever we have access to right now, which is US, Japan, Taiwan, China, we can do that. We can have invest completely on India, right? We can invest in debt funds, debt ETFs, and we can invest in precious metals, which is majorly again through ETFs, right? So minimum investment is 50 lakhs. The fund philosophy is that it has no cap on a particular category. So we can invest across the globe. We can invest completely in India. We can invest in entirely in debt. We can invest entirely in precious metals as well. Right. So the minimum is 50 lakhs. Okay. If an investor wants to do China, what are the alternatives? There's no alternate. Then you have to go to open your trading account in the US and transfer money from here to there and invest through US, but you're not getting shares. Again, I'm telling you, you're not getting shares. You're not getting ownership, right? Even the big ETFs that are there in the US invest through a Hong Kong exchange, right? Where Hong Kong exchange also you do not get the shares. You only get a contract, right? So the alternate is only that you have to go outside India to do it. All right. If there are no further questions, then thank you all so much for joining in. Have a great Sunday ahead. We'll keep on doing more interesting webinars of this sort, but please understand that there are very, very big risks when you're doing it. So I think it's better for you to work with a professional manager when it comes to understanding these risks, right? Right. Stay aware, stay invested. All right. Thank you so much.